Most retirees assume that their taxes will go down once they stop working. And that sounds very reasonable. No paycheck, no commuting, no earned income. So naturally, a lot of people expect retirement to come with a lower tax bill too. But what surprises many is that retirement income can actually create higher taxes than expected. And often it's more nuanced and complicated because of this level of income taxes that is based on various income sources. It matters where it's pulled from, what kind of account, and what tax classification. So in retirement, the income doesn't come from just one source. It comes from a mix of many sources, such as Social Security, 401k withdrawals, IRA withdrawals, brokerage accounts, pensions, capital gains. And unfortunately, for a lot of folks, those are required minimum distributions, usually in your mid 70s. And each one gets taxed differently. And that's where this gets really kind of messy as it relates to taxes long term. In fact, what usually happens is people spend 30 or 40 years doing exactly what they were told, just maxing out retirement accounts. Nothing wrong with that in general, but that's deferring taxes and building large pre tax account balances. And later in retirement, they realize they create a future tax problem without even really knowing it. Because once Social Security starts, once those required distributions begin, once Medicare premium thresholds enter the picture, they suddenly lose flexibility over how taxable income gets created. And then often the modified adjusted gross income for other purposes can also become an issue for certain taxable items. So today I want to walk you through 7 retirement tax planning steps that can help retirees potentially reduce taxes, improve income efficiency, and create more long-term flexibility in retirement. So we'll cover how retirement income is actually taxed, why your income gap matters, how withdrawal rates affect tax strategy, where Roth conversions could fit in, why Social Security timing matters more than people realize, how tax diversification creates flexibility in retirement, and ultimately why healthcare and estate planning can be very important to look at, not just now, but throughout retirement. I'll also go over one strategy that could potentially save some retirees thousands, tens of thousands, or even more over their lifetime if it's implemented correctly. But before we begin, if you'd like help building a personalized retirement income and tax strategy around your own situation, there's a link in the description where you can schedule a call with our team at Cornerstone Wealth Planning. Okay, let's begin. So, step one, let's understand how retirement income actually gets taxed. So, one of the biggest mistakes that retirees can make is assuming all retirement income gets taxed the same exact way. Well, it certainly does not. And once you understand this, retirement planning starts looking completely different. So, for example, traditional IRAs and traditional 401k withdrawals are generally taxed as ordinary income. That means if you withdraw $100,000, that entire amount can count towards your taxable income. Social Security can also become taxable depending upon your overall income picture. So, in some cases, up to 85% of your Social Security benefits could be subject to paying tax on. Now, brokerage accounts can be a little bit different because now we're looking at accounts when you draw dollars out that are taxed based on long term or short term capital gains, where the long term capital gains may receive more favorable tax treatment than IRA withdrawals. Now, also Roth accounts, these are much different because qualified Roth withdrawals will likely come out tax free. Now, here's why this matters. Most people do this where they simply spend and they save and they do this for decades into the future. And so they've heavily funded perhaps their 401ks and other employer plans, these pre tax accounts, because they believe I'll just take it out later in retirement when I'm in a lower tax bracket. That assumption can quietly create some problems potentially, because later retirement, you may also likely have Social Security income, the RMDs, the investment income, capital gains, maybe you have a pension or rental income, and suddenly taxable income starts to stack on top of each other much faster than expected. And that's the retirement tax trap that most people never really see coming. Not because they make bad decisions, but because nobody showed them how all these income sources will interact together later in retirement. So before we keep going, if this video is helping simplify retirement planning concepts that usually feel overwhelming, then just do me a favor and hit the like button below. It really helps this channel reach more people that are trying to make smart and wise retirement decisions. Okay, next up, Step two, identify your retirement income gap. So once you understand how retirement income gets taxed, the next step is figuring out what your investments actually need to do for you in retirement. Now, this sounds simple, but most retirees have never formally calculated this key figure. So let's start by understanding how we calculate this income gap, and we'll do that by listing out our guaranteed income sources. So when we think about guaranteed income sources, we're going to begin with things that we know will continue to come in no matter what the markets or economy are doing. For most everyone, this is Social Security. For some folks, you may still have a pension from an employer or the government. This could also be things like rental income. And, if you're still going to keep doing some level of work, then that can be a part of this overall calculation for now. But you certainly want to make sure you take that out long term, unless that's going to continue more indefinitely. So, this is really anything more predictable. And then we're going to do the next step, which is to compare this to your actual retirement spending goals. So, this would be calculating the expenses. So, housing, travel, healthcare, income taxes, property taxes, overall lifestyle spending. Now, the easy part of the calculation here is simply that the difference between these two numbers is known as your retirement income gap. So this number matters because it tells you how much pressure your portfolio will carry throughout retirement. Now, it also tells you something else. So it can help you understand how much taxable income you may actually need to generate from these investments, because once withdrawals begin, the tax strategy and the withdrawal strategy, they all become deeply connected. And that's where retirement planning shifts away from just accumulation and is really more about coordination. So step three, let's understand what your retirement withdrawal rate is really telling you. So a lot of retirees focus heavily on just investment returns, but really withdrawal rates often matter more or just as much. So here's a simple example. If someone needs $50,000 per year from their investment and they had $1 million invested, that's a 5% withdrawal rate that they're beginning with. Now, historically, many planners reference the 4% rule as a general guideline to begin with. Now, retirement planning is much more nuanced than this overall, because retirees today are dealing with longer retirements, healthcare inflation, tax uncertainty, market volatility, and overall sequence risk based on how markets perform whenever they begin withdrawing money from the portfolio. So the real question isn't simply how much can I withdraw, but it's about how much and how do I withdraw this in a effective, efficient, and as much as possible safe manner. Now, this is a much more sophisticated planning conversation because a withdrawal strategy that looks fine on paper can become very inefficient once taxes are layered in. So this brings us to step four. We should use Roth conversions strategically, and this is where retirement tax planning can become so incredibly powerful over time, because especially during these lower income early retirement years, a Roth conversion simply means moving from pre-tax retirement accounts over to Roth accounts while we control the timing of the taxes. And this becomes especially valuable during what many planners call the gap years. Let's say someone retires early, let's say age 62, but delays Social Security until later, and the RMDs haven't started yet either. Those begin in your mid-70s. So that temporary window may create unusually low taxable income years, and that can create opportunities to convert portions of this IRA money at lower tax rates before these future RMDs create larger tax exposure later. And this is where people get into trouble if they really oversimplify Roth conversions, because Roth conversions could affect Social Security taxation, Medicare IRMA premiums, capital gains, tax brackets overall, and your ultimate retirement cash flow and the design of that. So this isn't just converting everything to Roth all at once. That's not really the strategy. Strategy is coordinating these conversions to intentionally, over time, save you lifetime income taxes. And honestly, this is where integrated retirement planning becomes so extremely valuable, because tax decisions rarely happen in isolation. So if you'd like help evaluating whether Roth conversions or other tax planning strategies and opportunities may make sense in your retirement plan, click the link in the description where you can schedule a free call with our team. Now let's move into another area retirees often oversimplify. So step 5 is Social Security timing is also a key tax decision. A lot of people think Social Security planning is simply should I take it early, wait till full retirement age, or delay till 70? That's only part of the equation because Social Security timing can directly affect many other key items. Taxation overall, withdrawal sequencing, do you have a Roth conversion opportunity that could be missed because of that? What will your surviving spouse's income be? And long term retirement flexibility. So, some retirees delay Social Security specifically because it allows them to intentionally fill the lower tax brackets early in retirement through Roth conversions, or if you need the cash through strategic low tax withdrawals. Now, others may take Social Security earlier because of cash flow needs. They have significant health concerns and shorter life expectancy, or other portfolio considerations. Now, the important thing is understanding that Social Security doesn't exist separately from the rest of the overall retirement plan. Every decision affects another decision. And that's why retirement planning works best when everything is coordinated together instead of everything being treated individually. This brings us to step 6. Let's build tax diversification into our plan before we need it. Now, most retirees diversify investments. Now, far fewer are strategically diversifying their tax exposure. But tax diversification can become one of the most valuable forms of flexibility later in retirement. Think about the difference between these two retirees. One retiree has almost everything in pre-tax retirement accounts. The other has some Roth money, some brokerage account money, and some pre-tax accounts. And they also have cash reserves. Now, who has more flexibility when they have withdrawals? Usually the second retiree because they have options of where to pull from. In some years, they may pull more from that Roth account to reduce taxable income. Other years, they may intentionally realize capital gains if they can do it in a lower tax bracket situation. And that flexibility matters enormously later in retirement because the goal is not avoiding taxes completely. The goal is avoiding unnecessary taxes because the retirement plan lacks flexibility. Brings us to step 7. Let's not ignore healthcare and estate planning. This is where retirement tax planning becomes much bigger than just looking at investments because taxes affect far more than just the IRS bill itself. Income decisions affect long-term Medicare premiums. Your long-term care planning can be impacted, estate transfers or estate planning impacted, surviving spouse taxation is important to understand, and overall future healthcare costs are one thing we need to plan for. So, for instance, a large Roth conversion could reduce future required distributions, but it could also temporarily increase your Medicare premiums if income pushes you too high in a given year. Now, that does not automatically make it a bad decision. It just means retirement decisions always need to be coordinated. Now, the same thing applies to estate planning. With estate planning, some retirees prioritize leaving tax-efficient assets to their heirs. Others prioritize maximizing retirement income for themselves while living. And others just simply want to simplify their finances for their surviving spouse later. Those goals can lead to a very different outlook on various tax strategies. And this is exactly why comprehensive retirement planning matters so much. And at Cornerstone Wealth Planning, we help clients connect all these dots. Retirement income planning is over here, connects to your tax strategy over here, Social Security timing, your healthcare decisions, withdrawal sequencing of where to pull from, and estate planning all work together because every retirement decision affects another decision later on. And that coordination is often where the biggest opportunities will show up. So here's the bottom line. Retirement tax planning is not about finding one magic strategy. It's not just about Roth conversion. It's not just about your Social Security timing. It's not just about minimizing this year's tax bill. It's about understanding how all the pieces interact over the next 20 or 30 years throughout your retirement. And that is real work. The retirees who usually create the most efficient outcomes aren't necessarily the ones who earn the highest returns every year. They're often the ones who avoided costly mistakes, created flexibility for themselves, and plan proactively before these problems begin to show up. So if you'd like help building a personalized retirement plan, an integrated plan that captures all these various areas for yourself, please click the link in the description below, and our team at Cornerstone Wealth Planning would love to sit down and have this conversation with you to help you connect all these very key dots in retirement planning. Thanks for watching. I'll see you on the next video.